You spent 4 years in a classroom being taught accounting, or you're about to. Either way, nobody told you what accounting actually is. They just handed you a textbook, a calculator, and a syllabus that looked like a ransom note. Let's go. What accounting actually is? It's not math. Stop thinking it's math. A calculator does the math. Accounting is the language businesses use to tell the truth, or to lie very convincingly about how much money they have, how much they made, and whether they're going to survive next Tuesday. Every number on a financial statement is a sentence. You're learning to read. That's it. Now, before we go anywhere, you need 3 words tattooed somewhere visible. Assets, liabilities,
Equity. Assets. Everything the business owns. Cash, buildings, inventory, trucks, patents, goodwill. Goodwill is a made-up number that means we paid too much for this company, but we're not admitting it. More on that later. Liabilities. Everything the business owes. Bank loans, unpaid bills, taxes owed, promises the company made and hasn't paid for yet. Equity. What's left? Assets minus liabilities equals equity. That's the accounting equation. Every transaction on earth,
every single one, keeps that equation balanced. Assets go up, something else goes up, or liabilities go down. Always, without exception. That's called double-entry bookkeeping. Luca Pacioli invented it in 1494. Yes, 1494, the same year Columbus was sailing around looking for India and finding the wrong continent. We've been running the same system since then. Congratulations, modernity. So you understand the equation. Now here's where your textbook lied to you. The balance sheet doesn't show you what a company is worth. It shows you what the company paid for things, adjusted for how old those things are. Your office building, bought in 1987 for $2 million, still on the books at something near $2 million, minus depreciation. What's it worth today? Maybe $18 million, maybe $6 million. The balance sheet doesn't know, doesn't care. That's called historical cost accounting. In theory, it's reliable. In reality,
it's a photograph of a company taken in the wrong lighting at the wrong time. Moving on.
The income statement. This one people think they understand. Revenue minus expenses equals profit. Simple. Except it's not revenue when money arrives in your bank account. It's revenue when you earn it. You deliver the product, you've earned the revenue, even if the customer hasn't paid yet. That's called accrual accounting, and it creates one of the most dangerous illusions in business. A company can be profitable on paper and completely broke at the same time. Here's how. You sell $10 million worth of software in December. You record $10 million in revenue. Profit looks stunning. But your customers have 90-day payment terms. You owe salaries in January. You owe rent in January. Your bank account has $40,000 in it. You're profitable. You're also dead. That gap between profit and actual cash lives on the cash flow statement, the most important financial statement that most accounting students ignore because it's the hardest to fake. Spoiler, everything gets easier to fake when you move away from cash. Let's talk about the cash flow statement properly because this is the one that saves companies. 3 sections: operating activities, cash from running the actual business; investing activities, cash spent buying long-term assets or received from selling them;
financing activities, cash from borrowing money or issuing stock, or cash spent paying back loans and dividends. A healthy company generates positive operating cash flow. That means the core business produces real money. Everything else is noise. Plot twist. Some of the most celebrated companies in history burned through operating cash for years, and the market loved them anyway. Amazon lost money operationally for most of its first decade. Bezos just kept reinvesting into infrastructure.
The bet paid off. Most companies that try this strategy simply run out of money and disappear. The ones that survive get retrospectively called geniuses. The rest get called cautionary tales. That's survivorship bias, and it's not in your accounting textbook. File that away.
Now here's where your degree actually starts. Everything up to this point, the 3 statements, the equation, accruals, that's the foundation. Second year of your program is where they introduce standards, rules. Because left to their own devices, companies will make their numbers say whatever they need them to say. Enter GAAP, Generally Accepted Accounting Principles, or IFRS, International Financial Reporting Standards. GAAP is mostly the United States.
IFRS is most of the rest of the world. They agree on roughly 80% of things. The other 20% is the accounting equivalent of a bar fight nobody can stop. Revenue recognition, inventory valuation, lease accounting. These aren't boring topics. These are the exact places where companies hide problems. Learn the rules. Then, learn where the rules have gaps. The gaps are where the interesting stuff lives. Inventory valuation.
Because this one actually matters and nobody explains it correctly. You sell phones. You bought 100 phones in January at $200 each. Then you bought 100 more in March at $250 each. You sell 100 phones in April. Which ones did you sell? The $200 ones or the $250 ones? You don't know. They're phones, they're identical, but your answer changes your profit. FIFO. First in, first out. You sold the $200 ones first. Cost of goods sold is lower. Profit is higher. Taxes are higher.
During inflation, FIFO makes your company look more profitable than it is. LIFO. Last in, first out. You sold the $250 ones. Cost of goods sold is higher. Profit is lower. Taxes are lower. LIFO is banned under IFRS, still allowed under US GAAP. American companies love it. Regulators are conflicted about it. Economists argue about it at conferences nobody attends. Weighted average. Just average everything out. The compromise option. Boring, defensible, fine.
Same shelves, same phones, 3 different profits. That's legal accounting. Right. Moving on.
Depreciation. Your building doesn't last forever. Your textbook will act like it does. You buy equipment for $500,000. It has a useful life of 10 years. At the end, it's worth $50,000 as scrap. You need to spread that $450,000 cost across 10 years. That spreading is depreciation. Straight line. $45,000 per year. Simple, predictable, boring. Most companies use this. Declining balance. You depreciate more in early years, less later, because assets usually lose value faster when they're new. Makes sense logically. Creates lumpy numbers. Accountants who like complexity love this one. Here's the thing nobody tells you. Depreciation is a non-cash expense. You already paid for the machine. Depreciation just spreads the accounting recognition of that payment over time, which means cash flow and profit can diverge dramatically based purely on how you choose to depreciate things. Same asset, different method.
Different profit, different tax bill, different story. That's accounting.
Now, let's talk about what happens when the story goes completely off the rails. 2001, Enron Corporation, 7th largest company in the United States by revenue, worth $68 billion on paper, employing 20,000 people, named Fortune's most innovative company in America for 6 consecutive years. 6. Here's what they were actually doing. Enron used something called Special Purpose Entities, SPEs, which are legal structures that technically aren't part of the main company. You park debt in them. You park bad assets in them. And under the accounting rules of the time, if an outside investor owned at least 3% of the SPE, Enron didn't have to put it on their balance sheet. 3%! That's the loophole that hid $30 billion in debt from investors. Their CFO, Andrew Fastow, ran some of these SPEs personally.
He was paid $30 million in management fees by entities he was supposed to be overseeing on behalf of the company he worked for. That's not aggressive accounting, that's fraud with a spreadsheet attached. The auditors were Arthur Andersen, one of the 5 largest accounting firms on earth. They audited Enron. They also consulted for Enron. That year, they collected $52 million in fees from Enron, $27 million for audit, $25 million for consulting. Their financial incentive was to keep Enron happy, so they did, until they couldn't. October 2001, Enron restates earnings going back to 1997, $600 million in profit that never existed. December 2nd, 2001, Enron files for bankruptcy. At the time, the largest corporate bankruptcy in American history. Employees lost their retirement savings. Shareholders lost everything. Arthur Andersen collapsed within a year, taking 85,000 jobs with it.
The moral: the rules only work when everyone in the room wants them to. When the incentives break, the numbers break too. Congress responded with the Sarbanes-Oxley Act of 2002. CEOs and CFOs now have to personally sign off on financial statements. Criminal liability for knowingly false certifications. Up to 20 years in prison. That's what it took to make executives care about accuracy. A law with a prison sentence attached. Back to your degree. Third year. Cost accounting and management accounting. This is where accounting stops talking to external people, investors, banks, tax authorities, and starts talking to internal people, managers, operations, strategy. Cost accounting answers one question: what does it actually cost to make this thing? Direct materials, direct labor, manufacturing overhead, those three go into the cost of a product. Easy to say, hard to calculate, because overhead is a nightmare. Your factory rent, your supervisor's salary, your electricity bill, none of those attach neatly to a single unit of product. You have to allocate them. How you allocate them changes the cost of every product you make. Use machine hours? Products that use more machines get more overhead assigned. Use labor hours? Labor-intensive products carry more cost. Use revenue? Bigger revenue products absorb more overhead. Same factory, same products, three completely different cost structures, three different pricing decisions, three different strategies. Activity-based costing was supposed to fix this. Instead of dumping overhead into one big pool, you trace costs to specific activities. You use a lot of quality inspections? Your product pays for quality inspection cost. Makes more sense. Takes 10 times longer to implement. Large manufacturers love it in theory. Half of them give up during implementation. Management accounting goes further. Break-even analysis. How many units do you need to sell before you stop losing money? Fixed costs divided by contribution margin per unit. That's it. But that number, your break-even point, changes every time your fixed costs change, every time your price changes, every time your variable cost per unit shifts. Budgeting. Building a financial plan for the year. Every department, every cost, every expected revenue. Sounds logical. In practice, every department manager inflates their budget request by 20% because they know finance will cut it. Finance cuts it by 15%. Everyone ends up with 5% extra they didn't need. That's called budget slack. It happens everywhere, every year, on purpose. Variance analysis, comparing what you planned to what actually happened. Favorable variance, you spent less or earned more than planned. Unfavorable variance, the opposite.
Finding the variances is the easy part. Understanding why they happened is where the real accounting work lives.
Fourth year, audit and taxation, the parts everyone dreads. Audit, an independent review of financial statements to determine whether they're presented fairly. Not perfectly, not correctly, fairly. That word matters. Auditors don't guarantee accuracy. They provide reasonable assurance. There's a legal difference. The expectation gap, what the public thinks an audit guarantees versus what it actually guarantees, is enormous and intentional. An audit involves sampling. You have 50,000 transactions. The auditor looks at maybe 200. Statistical sampling tells them whether the whole population is likely to be materially correct. Materially means big enough to matter to a reasonable investor. Small errors don't fail in audit, big ones do. Taxation, where accounting meets government. Tax rules are not accounting rules. They're different frameworks running simultaneously on the same company. Profit for accounting purposes and profit for tax purposes can be completely different numbers. That gap creates deferred tax assets and deferred tax liabilities, which exist on the balance sheet purely because the two systems disagree about when to recognize things. Tax avoidance is legal. Tax evasion is prison. The line between them is what keeps an entire profession employed.
Zoom out. Here's the full picture. You started with a simple equation. Assets equals liabilities plus equity. That equation never breaks. Everything else, accruals, depreciation, inventory methods, SPEs, variances, audits, tax timing differences, is just the system trying to handle the complexity of the real world while keeping that equation intact. The balance sheet tells you what the company has. The income statement tells you what the company earned.
The cash flow statement tells you what the company actually generated in real money. If those three documents agree about reality, the company is probably fine. If they start telling different stories, something is wrong. Or something criminal is being covered up. Accounting isn't about the numbers. It's about what the numbers are hiding. Every career in finance, every investment decision, every credit approval,
Every M&A deal, they all start with reading these three statements and asking one question. What is this company trying not to tell me? That's the skill, not debits and credits, the skepticism. You wanted to know what accounting is. Here it is. It's the system humans built to keep score in a world where everyone has an incentive to cheat. At its best, it creates transparency. At its worst, Enron, WorldCom, Wirecard, take your pick, it creates the most sophisticated lies money can buy. You're a human. You wanted a degree, maybe a job, maybe to understand how money actually moves through a business. Nobody told you accounting is the foundation of every financial decision ever made by anyone with more than $12 in their bank account. Now you know. The degree didn't give you that. The honest admission, the numbers are the easy part.
knowing when to trust them, that takes longer than any degree. If you got value from this, hit subscribe. We break down business, finance, and economics every week. Drop a comment. What should we explain next? Thanks for watching. See you in the next.